Transparency was supposed to protect traders on Hyperliquid. Instead, it turned their losses into crowdsourced trading signals. Unlike traditional exchanges that hide large positions, Hyperliquid records every wallet, position size, and liquidation price on-chain in real time. Anyone can watch. On June 23, a whale known as Machi Big Brother was liquidated 7 times in 10 hours on leveraged ETH longs. Each wipeout was visible to thousands of traders monitoring the platform. Ethereum sat at $1,607 the next day as $213 million in futures liquidations swept the market. But here's what changed: traders weren't just watching for entertainment. They were using those public liquidation zones as actual entry points. The mechanism is simple. When a big position becomes visible, its liquidation price becomes a reference point the entire market can see. Price tends to move toward clusters of liquidations because that's where the liquidity sits, the forced selling that large players need to fill orders. Once the cluster gets triggered, the pressure disappears and price often reverses sharply. What was designed as radical transparency accidentally created a new form of signal. The more public the whale, the more predictable the squeeze. Bitcoin fell to new 2026 price lows as multiple headwinds converged on the cryptocurrency market. Spot Bitcoin ETFs saw sustained outflows, while MicroStrategy's unrealized losses on its Bitcoin holdings widened significantly compared to gains in AI-related stocks. The monthly options expiry added bearish pressure to an already weak market environment. The decline signals continued institutional retreat from Bitcoin as investors rotate toward AI stocks with stronger near-term returns. This divergence highlights Bitcoin's vulnerability to broader risk-off sentiment when traditional equity markets show weakness, undermining its narrative as a safe haven asset or inflation hedge.